Hey there, Ryan Black Real Estate Investor here, and in today's quick investing tip, I want to talk to you about tax liens and tax deeds. So tax liens and tax deeds are different, and sometimes people get them confused, and depending on which states you're investing in, you're going to have different options to choose from. So tax liens, first off, what is that? Tax liens and tax deeds is when you have property owners who default on their property tax, where they've not paid their property tax over a series of 1 to 5 years, then you can actually go and purchase an interest against that property in exchange for you making the tax payment to the government on their behalf. So let's say we have a tax lien state, right? Or a tax lien. It's not just by state. It could be by city, by county, right? Every jurisdiction has different rules. But let's look at a tax lien, right? Tax lien situation. So with a tax lien, we've got somebody who has not paid their property taxes for the last couple of years. And so they are offering tax liens, which means you as an investor can come in and purchase basically a lien against that property at a guaranteed interest rate in exchange for you paying off the taxes that are owed. So let's say they owe, $5,000 in back taxes. And so you come in, you purchase that tax lien. So you pay the $5,000 to the government. Now the government is happy because they have their tax money, and you now have a recorded lien against that property. So if that person wants to sell the property, obviously then your lien has to be satisfied. Interesting fact, tax liens will supersede any other lien. So even if the person has a massive, first position mortgage on the property, your tax lien automatically will go above that and push the mortgage into second position. So you, by default, the tax liens will always go into first lien position. Now, once you have that, the interest, and there's, depending on where you're purchasing your liens, there are different options. Some of them you auction and you bid down the rate, or you bid up the rate, or they just offer a flat rate of what you'll receive by purchasing it. But there's always, regardless of how it's determined, there is a set interest rate or dividend that you receive on that money. So however long you hold the lien, you're just accumulating dividend, and then once it is redeemed, once they redeem the lien, then you are able to receive your interest on the money that you put in. So it's a cool way to be able to have a very, very secure investment with a solid ROI. You just put the money and then you have the guaranteed, and the return is guaranteed by the government, right? It's the county who is putting that lien out there, and so they're guaranteeing you are going to get this return, because they will not clear the lien until you receive all your principal back with your interest that was accrued over time for that amount for that rate. So that's tax liens. Hopefully that clarifies a little bit. What if we are looking at a tax deed situation? So for tax deeds, those are a little different. Rather than putting your money down and then receiving a guaranteed interest or dividend off of that money, what you will do is you're actually purchasing the deed of the property. Now there is a process as far as redemption and being able to, after you purchase the tax deed, being able to actually, basically what you're doing is foreclosing on the property and taking it. But in every jurisdiction is different, so I don't want to get into details on that. But basically, you're putting your money down, and in exchange, you get a tax deed. You get the deed. You receive ownership of the property. Now that can be really cool, but you could also get properties that are completely just destroyed, and really all you're buying is the land. And so you got to be careful. You got to do your due diligence, of course, when looking at any of these things. But in looking at, certain states are definitely more conducive to tax liens and tax deeds than others. So you want to do some research, do some online research, and figure out if where you live is good or bad. For example, I live in Utah. Utah, not good for tax liens and tax deeds. It's not a good market for it. There are other markets you don't have to live where you're investing, right? There are other markets that we're looking at and that we're working on purchasing some tax liens in, because it's very lucrative there, right? And so you just got to get to know that. And also you have to time it right too, because many jurisdictions, they will only have their sales once a year. And sometimes it's only like one day. You have one day a year where you can go and you can bid or you can purchase, and that's it. So if you missed your window, you have to wait another year. So it's a very interesting strategy. Some folks really love it because you can just do it from home. You know, you just basically you're online and you're doing all the stuff that you need to do online. But can be a great opportunity if you've got some capital that you want to invest, you want to get a solid return on, or as tax deeds, if you're trying to acquire properties using a different kind of creative strategy and you want to go down that route, can be a great option. Hopefully that cleared up a little bit for you, the differences between tax liens, tax deeds, and some of the benefits that you can get from them.